Hey, everybody, welcome in. Listen, I am in the United Arab Emirates today, and I'm here because I went to an international conference with Gulf Intelligence. They brought together 300 oil and gas experts from around the globe to talk about crude oil markets, LNG markets, LPG markets, a lot of different markets. But what I'm going to talk to you about today is going to be about the oil markets. So, the oil markets, when we're looking into the future, or when we're looking into 2026, because that's what we're really going to focus on today. So, oftentimes when we're looking at the oil market, we're looking at right now, we're looking at today. So, today I'm actually going to talk about 2026. It's time to start planning for 2026. What is ahead of us? Well, put simply, we are looking at a bearish outlook for crude oil. And why? There's a couple of different reasons why. One of the key reasons is the growth engine for oil over the last 15 years has been China. Now, there's been growth in other areas. India's grown. The United States has grown. Europe has grown. There's actually been some growth there, believe it or not. Not much, but some. So a lot of mature economies, there's been a lot of growth in Africa. So you got Africa, India, but China has been continually adding more and more and more demand. So the question is that demand going to continue into the future? Now, one of the key questions that is underlying that is the demand that they're having in 2025, because they're having pretty strong demand from their import side. Why? Not because of demand growth. This because they are expanding their strategic petroleum reserve. They keep building more and more capacity that is actually going to dwarf the United States when it comes to the strategic petroleum reserve. So when we're looking at China, that demand profile is starting to stall. And it doesn't mean it's going to decline or tip or anything like that, but it means that it's going to match a mature growth curve of the EU, of the United States. And these growth curves are not very large from a percentage standpoint. So when the world was growing by 2 to 3%, that's because China was growing by 7 to 10%. Well, now China's growth is probably going to be 3%, which means the aggregate growth of oil demand is probably going to be down in the 1 to 1.5% range from here on out until India gets to significant volumes, which could be coming. So, but in 2026, that outlook for the Chinese demand is going to be bearish. So I would say bearish outlook on Chinese demand. The number two thing that we're looking at is the oil projection for demand growth. IEA and OPEC already have their 2026 numbers out. OPEC is expecting 1.4 million barrels a day of growth in demand. IEA is about half that at 700,000. So you're going to have a discrepancy. And oftentimes it's somewhere in the middle. OPEC has always been a better North Star when it comes to predicting oil markets. So if I was to call a number right now, I'd say 1.2 million barrels a day of growth. So that's what I'm looking at for oil projections on demand growth. Now, that is also linked in with how much Chinese demand, so these are all interlinked there. The last key thing that I've learned in the United Arab Emirates as I'm here talking to people from the Middle East, talking to people in Europe, in Australia, in North America, South America, everywhere from around the globe, is that the biggest risk factor that we have is going to be in geopolitical. So geopolitical is the key component that everybody is looking at to decide whether or not we're going to have a lot of volatility in the oil markets. And guess what? We are. Now, the real question is that volatility going to be to the upside or is it going to be to the downside? These are bigger questions at play. What I will say is non-OPEC plus supply is having pure fatigue. If you look at last year, oil prices were about $10 higher than they are right now. Well, now oil price and oil putting capital expenditures towards oil growth is difficult because when you look at expending that money, they're not getting much in a return. You know, it's getting harder and harder on acreage. It's costing more and more. In the past 10 years, we've grown by 50% on a cost basis on how much it takes to produce. So if you look at it, the cost per foot, it's up about 50%. So 50% increase in cost to 10 years ago, about the same oil price. So that means your economics are really, really squeezed. Now there is a little bit of efficiency gain, but the cost is a real cost figure. So that is something important to understand. So I'm going to wrap this up and really keep this kind of to a shorter session today, but 2026 looks bearish. I would say probably top line is $70, probably bottom line is probably 50, possibly into the 40s. I don't think we'll get there. I think we're headed down, but then we will head back up because structurally a lot of places aren't going to be expanding supply. And if they're not expanding supply, that means that we're going to have a better supply and demand balance, which is going to support the price. So let's recap. China demand is topping out. It's not going to decline, in my opinion. I'm not a financial advisor, read all the disclaimers below, but Chinese demand is kind of topping, and I would expect it to fall in line with a growth curve on oil demand that matches North America or Europe. So that means if it's matching that, then the global growth is not going to be very big. Number two, oil projections for demand growth. IEA is showing 700,000 barrels a day, and OPEC is showing 1.4 million barrels a day. The question is, who's right? You know, and this is often the case. IEA is usually on the low side. OPEC is usually on the high side, and the answer is usually somewhere in the middle. That said, I would say there's a magnet towards the OPEC numbers. They're usually closer to the mark, and so I'm putting 2026 at about a 1.2 million barrel a day demand growth. Number three is the biggest risk factor is going to be in geopolitical. This I agree with, and I will say if we reach peace agreements or the wars start settling down, there will be a downward impact, not because of true fundamentals in the oil and gas market, just because of the psychology, the trading psychology. So I would expect it to go down and then head back up. Now, adding in the last component, the last thing I wanted to talk about, which is non-OPEC plus supply is harder and harder to make money. And with it being harder and harder to make money, that means that we aren't likely to grow supply on non-OPEC plus. You add in all this, I don't see an incredibly intense bearish story. I see more of a slightly bearish story, but really that expands into a short-term bearish cycle with a long-term bullish cycle. So anyway, tell me what you think in the comments. I just wanted to get this out, and I'm recording this in the Middle East, and so I hope you're having a fantastic day, and we'll talk soon. So enjoy your day, and I really appreciate you stopping in today. So thanks so much. Bye-bye.